So I think a couple of the key takeaways from the regulatory summit were, first, a year after elections votes through 2016, 2017, and the unknowns that might come out of those, folks feel like we're really coming to the new normal. New normal characterized by three things. The first is getting back to the business of finishing the post-crisis reforms, including Basel III. The second is a realization that the rollback of regulation really isn't going to happen, not at the scale that people had anticipated, and certainly not for the largest, most systemically important institutions. And the third is a thawing of the supervisory dialogue, a real change in the supervisory mindset to one that is much more transparent and much more willing to engage. All of that, though, with a backdrop of continued concerns about the complexity of regulation and the volume of regulation, and how all of the different regulations may actually work together or may not work together. So thinking about things like MiFID II, PSD2, GDPR, and the Basel reforms, how do all of those actually work together? So continuing concerns about that. Second key takeaway was that the range of risks that both the regulators and the banking industry are concerned about probably haven't changed a ton, that the continued focus on non-financial risks and the importance of those, particularly things like cyber, like conduct, like culture, like fintech, continue to be at the top of everyone's list, particularly the challenges in measuring and monitoring those. But one risk that emerged and was a topic of real conversation, and sounds like it's one that folks are starting to pay a lot more attention to, is the business model, the viability of the business model going forward, the threat that fintech poses to the banking industry, and the question about how banks can get back to robust profitability and really have a business model that can thrive in the future. That seemed to be emerging at the top of many people's minds during the regulatory summit.